Hello, I'm Zach Houston, and I'm kicking off the third project completed by Group 2 for Accounting 514 Managerial Accounting. Our third project focuses on variance analysis, and we've applied the concepts of variance analysis to consulting firms. In this presentation, I'll cover variance analysis and how it can be applied to consulting firms. Burkell Mansfield will then cover how to set up variance analysis using standard costing in a spreadsheet format. Next, Anthony Green will discuss some interpretations of this variance analysis. Finally, Lincoln Cook will discuss potential management actions that can come from this sort of analysis. Variance analysis compares actual results against expectations to suggest an action. Variance analysis divides variances in a manner in which each variance can be used to imply an action. This is necessary because there can be many different causes for revenue and cost variances between actual results and planned budgets. So when analyzing that variance, we have to parse out the variances based on their cause. This can be done by converting variables like price and quantity into standards that represent our expectations for the coming year. Standards are expectations that lead us to an explanation of the total variance. The basic tenet of consulting firms is that experts in an area of study sell their time for money in a consulting arrangement. All professional service firms, like public accounting firms, law firms, and engineering firms, are consulting firms. We believe understanding how to apply variance analysis to consulting firms is of particular importance for accounting students, as many may go on to careers in public accounting. There are two common standards used to explain variances. Those standards are standard prices and standard volume. Variance analysis can be used to break out the variance in financials of consulting firms by analyzing the difference in volume and price of hours sold, as well as the volume and price of the labor inputs. In consulting firms, labor also plays a role in the analysis of overhead costs, with indirect labor being a major component of overhead expenses. Indirect labor would be labor that is not charged to the client as billable. Other overhead costs in consulting firms is typically allocated out based on headcount. Most overhead costs in consulting firms vary based on the number of people employed by the firm. These sorts of costs would include location costs, benefit costs, including medical and retirement, travel and training costs, insurance costs, including auto, liability, and professional insurance, meals and entertainment, and professional fees. A typical actual to budget report for a consulting firm might look something like this. We can improve this report by utilizing the standard costing techniques to break out the variance between price and volume variances. With that, I'm going to turn over the presentation to Burkell Mansfield, who will describe how to set up a spreadsheet to divide the variances in each category of income and expense between price differences and volume differences.
Hi, I'm Brickell Mansfield, and I'm going to be talking about how to set up a variance analysis using standard costing for consulting firms. The first Excel sheet on our project is an input screen. It allows us to enter different variables and see the effects on a comparative income statement. The initial input section is split into an actual amount and a planned amount. The first item that we input is the total headcount. This is the total number of employees that work for a consulting firm. The amount that we enter there is then used to calculate total hours. Total hours is found by taking the number of employees and multiplying it by 2,080, which is 40 hours times 52 weeks. The last two lines are where we split up how many of the total hours are related to billable hours and how many of the total hours are related to non-billable hours. The numbers that we inputted on the previous slide then calculate cost per hour, price per hour, and corporate overhead costs. Cost per hour is found by taking our total direct labor cost and dividing it by our billable hours. Price per hour is found by taking our total fee revenue and dividing it by our billable hours. We decided that overhead cost is best driven by total labor hours. So in order to find our corporate overhead cost rate, we took the total overhead cost and divided it by total labor hours. Those variables are then used to help create a comparative income statement. The first two columns of the comparative income statement are actual revenue and expenses and budgeted revenue and expenses. We input these amounts based on our actual income statement for the period and our budgeted income statement for the period. The third column shows the total variance, which is found by taking the difference between our actual amounts and our budgeted amounts. The fifth column shows the amount that is related to a price variance, and the sixth column shows the amount that is related to a volume variance. This is our example of the comparative income statement. Based on our inputs and our actual and budgeted P&L amounts, we have a total favorable price variance of $922,867 and a total unfavorable volume variance of $481,400. Next is a breakdown of the volume variances into their static and flexible amounts. These amounts are all auto-populated. The first three columns consist of standard price, standard quantity, and actual quantity. The static amount is found by taking standard price times standard quantity. The flexible amount is found by taking standard price times actual quantity. The static amount and flexible amount are netted together to get the total variance. Next to those amounts is a cell that states whether that variance is favorable or unfavorable. At the bottom of this table is the total volume variance, which is found by taking revenue minus expenses to get to profit, and underneath that is a calculation to determine if the overall variance effect is favorable or unfavorable. This is an example of our volume variance breakdown. In this case, we get a total volume variance profit of negative $481,400, which matches the amount on the comparative income statement. The effect is determined to be unfavorable because the absolute value of the unfavorable variances is greater than the absolute value of the favorable variances. We also have a breakdown of the price variances into their static and flexible amounts. As with the volume variance breakdown, these amounts are auto-populated. The first three columns consist of actual volume, standard price, and actual price. The static amount is found by taking actual volume times standard price. The flexible amount is found by taking the actual volume times the actual price. These amounts are then netted together to get the total variance. Like the volume variance breakdown, there are cells that state whether each variance is favorable or unfavorable, a total price variance found by taking revenue minus expenses, and a calculation to determine whether the overall price variance is favorable or unfavorable. In our example of the price variance breakdown, we get to a total variance profit of $922,867, which matches the amount on the comparative income statement. The effect is determined to be favorable because the absolute value of the favorable variances is greater than the absolute value of the unfavorable variances. The next Excel sheet in our project is an analysis screen. In this screen, we break down the different variances and walk through the process step by step to see how we got to the results on the comparative income statement. At the top of the sheet is a basic version of our comparative income statement. It shows the same values as our comparative income statement on the input screen, but its cells are linked to formulas further down the page. It also has a rounding column that acts as a check figure to make sure that the combination of the price and volume variances equals the total variance found by taking the difference between the actual P&L amount and the budgeted P&L amount. Underneath the basic comparative income statement is a list of all the same input cells and automatic calculations taken from the input screen. As you can see from our example, it is basically identical to our comparative income statement and input summary on the first Excel sheet. The only major difference is the rounding column. All the numbers in our rounding column are 0, suggesting that the variances that we calculated below explain the entire variance found between the actual and budgeted P&L amounts. The next section of our analysis screen displays our revenue variances. Here we showed the formulas for calculating sales price variance and sales volume variance. In order to complete these formulas, we need actual sales price, budgeted sales price, actual unit sales, and budgeted unit sales. We find the actual and budgeted sales price by taking revenue and dividing it by billable hours. The actual and budgeted unit sales are the billable hours themselves. In our example, the sales price variance is $815,419. It is favorable because our actual sales price was higher than our budgeted sales price. The sales volume variance is negative $831,480. It is unfavorable because the actual unit sales were less than our budgeted unit sales. The next section of our analysis screen displays our labor variances. Here we show the formulas for calculating direct labor quantity variance and direct labor price variance. In order to complete these formulas, we need actual direct labor, budgeted direct labor, actual price, and budgeted price. We find the actual and budgeted price by taking direct labor costs and dividing it by billable hours. The actual and budgeted direct labor hours are the billable hours themselves. In our example, the direct labor quantity variance is negative $256,542. It is favorable because our actual direct labor hours were less than our budgeted direct labor hours. The direct labor price variance is $96,368. It is unfavorable because the actual direct labor cost was greater than our budgeted direct labor cost. The next section of our analysis screen displays our direct materials variances. Here we show the formulas for calculating direct materials quantity variance and direct materials price variance. These variances are not applicable in our situation. Our revenue only consists of fees collected from consulting hours. There are no physical objects involved. Thus, there are no direct materials and no direct materials variances. The next section of our analysis screen displays our variable overhead variances. Here we show the formulas for calculating the variable overhead quantity variance for indirect labor and other overhead costs. In order to complete these formulas, we need actual cost driver used, budgeted cost driver used, and predetermined variable overhead rate. For indirect labor, the actual and budgeted cost drivers used are non-billable hours. The predetermined variable overhead rate is labor cost per hour. For other overhead, the actual and budgeted cost drivers used are total labor hours. The predetermined variable overhead rate is the corporate overhead cost per hour. In our example, the variable overhead indirect labor quantity variance is $46,046. It is unfavorable because our actual cost driver used was more than our budgeted cost driver used. The variable overhead other quantity variance is negative $139,584. It is favorable because our actual cost driver used was less than our budgeted cost driver used. Here we show the formulas for calculating the variable overhead price variance for indirect labor and other overhead costs. In order to complete these formulas, we need actual cost driver used, predetermined variable overhead rate, and actual variable overhead rate. For indirect labor, the actual variable overhead rate and predetermined variable overhead rate are labor cost per hour. The actual cost driver used is indirect labor hours. For other overhead, the actual variable overhead rate and predetermined variable overhead rate are the corporate overhead cost per hour. The actual cost driver used is total labor hours. In our example, the variable overhead indirect labor price variance is $22,608. It is unfavorable because our actual variable overhead rate was more than our predetermined variable overhead rate. The variable overhead other price variance is negative $226,424. It is favorable because our actual variable overhead rate was less than our predetermined variable overhead rate. The final section of our analysis screen displays our fixed overhead variances. Here we show the formulas for calculating fixed overhead spending variance and fixed overhead volume variance. These variances are not applicable in our situation. In our simplified income statement, there are no fixed overhead costs involved. Next, Anthony Grain will expound on the results of the variance analysis.
Hi everybody, I'm Anthony, and I will be talking to you guys today about interpreting different types of variances and what they mean. There are 8 types of variances we can use, and I'll be explaining if they're favorable or unfavorable, why that is, and giving you possible reasons for the outcome. Our sales price variance became favorable for us. This is because the actual sales price per unit was more than the budgeted sales price per unit. This outcome could happen for many reasons. For example, a decrease in our number of our competitors in our market, better promotions and sales campaigns, and an improve in our consulting services. Our sales volume variance was unfavorable. This is because our actual unit sales were less than our budgeted unit sales. This could be because of many reasons like an increase in our unit price, an increase in our competition, a decrease in our consulting services, and government interference. Our direct labor quantity variance at our consulting firm was favorable for the year. This is because we used less direct labor hours than we had budgeted for. This could be because we didn't have as many clients for the year, or maybe we implemented new procedures to decrease our workload. The direct labor price variance was unfavorable for the year. This is because our actual direct labor price per hour was higher than what we budgeted for. There are many reasons this could have happened. One being our wages could have increased this year. Our employees could have been on overtime. Or we could have ran into some unforeseen complexities. Our variable overhead labor quantity variance is unfavorable because we had more non-billable hours than we budgeted for. This could have happened because travel time was more than expected. Another reason this could have resulted in this is business proposals, like going to potential clients and telling them why they should hire our firm. Our variable overhead other quantity is favorable because we budgeted for more than what we used. Since we only had a head count of 44 instead of 48 employees, we didn't use as much, which resulted in it being favorable. Potential reasons this could happen is loss of employees or software taking over day-to-day duties. The variable overhead indirect labor price variance was unfavorable because our actual costs went over budget. This is because we had so much more non-billable hours than expected. One of the reasons is we could have inadequately delegated to our employees. This is when difficult work is given to less experienced employees, resulting in more time used. Our variable overhead price variance is favorable because our VOH rate was less than we had budgeted for. This could be due to location costs increasing faster than anticipated, insurance costs being higher due to activity claims, or market inflation.
Hi, I'm Lincoln. I'm going to discuss some of the management level analysis that we can draw from the variances previously discussed. We're going to identify why the business had some of these variances, the effects the variances have on each other and correlated accounts, and identify potential action plans so that management can help the company continue the positives and also improve on the negatives. Our calculated price per hour was greater than what we planned by an increase of 13.4%. This was from our ability to complete our contracts with clients in fewer billable hours than we forecasted. This is a positive result because it shows that we had a higher level of hourly efficiency than we anticipated. We had actual billable hours amounting to 88% of our planned billable hours, yet we still achieved 99.8% of our forecasted total revenue. This is a bright spot because we were able to still achieve our desired revenue while our actual direct labor costs came out to be less than our budgeted by 7.5%. Resulting in a 3% overall improvement in our gross margin. However, due to our billable hour decrease from our budget, we fell short on our forecasted total hours, coming in at 91.7% of our planned total hours. This plays a role in the reason for why our actual non-billable hours exceeded our planned non-billable hours by 11.7%. The impact from this deficiency is that we took on less client contracts than we were capable of handling, thus resulting in the company missing out on potential earnings. As a result, moving forward, it is our goal to see this difference of actual and planned hours finish closer to a difference of 5% or less. How can we achieve this goal? By improving our forecasting of billable hours. This is easier said than done, but it will bring the most return. If we look at our variable overhead variances, the favorable overhead quantity variance is from our actual total hours being less than our planned total hours as we identified previously. The interesting piece is the overhead price variance. This is because the actual corporate overhead calculated to be less than planned, which came from our overhead coming in at 21.9% less than budgeted. This is a significant difference to what we expected, which needs to be noted when planning in the future. If you remember back to our billable hours difference and the lack of client contracts to work on, we chose to fill our employees' time with management projects that had been initially budgeted into our corporate overhead plan. This time was designated as non-billable hours, which is why our actual non-billable hours were 11.7% more than initially planned for. This also explains our indirect labor being 17.4% more than our budget. However, this allocation of costs from corporate overhead to indirect labor decreased our actual total overhead by 14.4% compared to our budget. Ultimately, this unfavorable variance decreased our total overhead, which improved our income from operations by 16.3%, even though our total labor cost increased by 3.6%, and we will gladly accept this trade-off. So, what action can we take from this analysis? Well, we need to remember that our employees were able to cover management overhead projects because our actual billable hours were less than we planned. We should not determine that we need to decrease our total overhead next year, especially if our ultimate goal is to forecast our hours more effectively. This theory puts into perspective the importance of our first action/goal. But if we have a situation like this again, we need to be prepared. So our second action is to be sure that we have management projects prepared that we could potentially have employees work on if needs be. Unfortunately, we had to let go of 4 employees from this situation because we were not prepared and had to adapt on the fly. Hopefully this action plan can help alleviate that issue and concern.
Hello, this is Zach Houston again. In this presentation, we've tried to explain how variance analysis relates to consulting firms, how to set up variance analysis for a consulting firm, possible explanations for the variance identified in our example, and how identifying the variance can assist management budget in the future and control costs and improve revenue. For all of us in group number 2, thank you for listening to our presentation. Hopefully it's been helpful and informative.